Hello everyone, so Cathie Wood has just come out with some claims about index funds and what she sees happening to them in the coming years. For those who don't know, Cathie Wood is the CEO of ARK Invest, which has done very well over the last few years. Also agreeing with her is Michael Burry, most famous from the movie The Big Short, who is also convinced of similar opinions and voiced them late last year. So today I'll look into these claims they are making to see what their thinking is behind them, so stay tuned. Hi everybody, welcome back to The Contrarian. My name is Logan. I really like to talk about investing and overall success, as well as the psychological nature of markets and going against crowd thinking mentality to really outperform the markets. I also want to make a disclaimer that none of this is to be taken as financial advice, and yeah, if you like these topics, just consider subscribing. So to begin with, I have made a video about Cathie Wood and her claims before, and this was with regards to Tesla and her price target of $7,000 in the next 5 years. Basically, I said that the fundamentals behind Tesla do not give anything close to this possible, and that if anything, they are already very overvalued as a company. Cathie Wood, on the other hand, looks at investing through a different lens of disruptive innovation, and her ETFs show this. She doesn't care very much about fundamentals, profitability, or anything that a Warren Buffett would be concerned about. Rather, she focuses on investing and innovating companies that are on the front edge of technology. Now, I will admit that this has worked well for her and others like her over the last 10 years. However, at any other point in time, you would not have lasted this long. The dot-com bubble, for example, is a very similar situation as what we are seeing right now, and that only lasted 4 to 5 years until it popped. So if in fact Cathie Wood is correct over the next 10, 20, 30 years, much longer periods of time, I think it shows that the investing world has changed permanently from what we thought it was. However, I don't think we're at that point yet of being able to say that this has worked well long term with Tesla and other growth companies. I like to be cautious and look at what has happened in the past as indications of what will likely happen in the future, but things do always change. And I think Michael Burry would definitely agree with me and others who voice skepticism as to Tesla's valuation. And he has recently tweeted about it actually, and how its valuation when compared to other automakers is orders of magnitude higher. But now let's look past Tesla and let's get into what they do agree on, and that is that index funds are potentially in a bubble right now. So now on to their claims about index funds. This is a very similar process I've talked about before. Basically, they are saying that by buying index funds and all of these ETFs and mutual funds and etc. that are linked to index funds, this is a very inefficient allocation of capital. It's a very inefficient way of allocating money into the stock market. Now, what do I say about it being inefficient? So basically, whenever you used to invest before index funds were this popular, you would either need to put your money in an actively managed fund that cost you an annual fee, or you had to do your own research and invest it in companies you thought were good investments. Those were basically your only two options. Now index funds come along, and they offer the same potential returns as an actively managed fund, but they cost roughly 1/10 of the annual fee, and you can buy and sell the entire index fund whenever you want, basically as if it were an actual stock. So now this has caused a massive inflow into passive investing and into index funds. Now anybody can basically achieve these average, 8, 9, 10% returns per year simply by these passive funds. And it would seem on the surface that everything is fine. But in reality, this gives the opportunity for there to be a massive imbalance in what companies receive incoming capital and which do not. Essentially, those that are included in passive investing funds and ETFs are the winners, and those that are not are the companies that get screwed, basically. Now, why would this be the case? Why wouldn't smart money, look for undervalued bargain stocks? And the answer to this is that with so many people simply buying index funds instead of looking for value companies, now all of a sudden the companies left out of the index funds are getting fewer and fewer buyers. It's all the Googles and Nvidias and Teslas and Apples and Amazons in the index funds that are receiving the incoming flow of capital. So this is the inefficiency that Cathie Wood and Michael Burry are referring to. If there is a simple phrase that could summarize the stock market, it would be price discovery. You put shares of a company on the market, and the market, composed of individual investors, ideally decides the valuation of the company. This is how the market should be functioning, simply based on the law of supply and demand. But passive investing takes away this functionality. It removes a lot of the analytical side of what investors would normally be doing. Now on to why index funds are in a risky position and could collapse in a giant crash, similar to how bubbles have ended in the past. Basically, you have a gradual flow of money coming in over the last 10 to 12 years since the housing crash happened. It's been very gradual, starting very slowly, and it's been a gradual flow into these assets in the last decade. And the system has been able to handle this, very slight change in flow. It's definitely not outside of the ordinary trading activity. You might, on any given day, maybe you used to have $50 million in a certain company's stock bought and sold on any given day, and now you have $51 million being bought and sold. It could even be as slight as this. But this still gives rise over time to a huge imbalance in capital, where you have a stock being owned by investors who simply bought an index fund. They never looked at the fundamentals of this company and decided if they wanted it. They simply had to buy it because they bought a share of the index fund. And this, company had, when they bought the index fund, it had to purchase a share of this company. So this is how index funds distort price discovery. But what happens if this flow reverses? What if a lot of people all of a sudden have a need for pulling their money out of index funds, such as for retirement, or they see the markets crashing and they just want to pull some chips off the table and take some profits? All of a sudden you have massive outflows of capital, orders of magnitude more than the inflow, and in order to sell there has to be a buyer to buy your shares. But what if nobody is willing to pay the current price for these shares because they feel that they're overvalued? The price needs to drop to a level at which buyers are willing to step in. And we saw this earlier this year with index funds during the shutdown. Prices fell anywhere from 30%, even up to 50% or more in a matter of 6 weeks. And moves like this are extremely volatile, and they're previously unheard of. We just did not see these kinds of moves before. This was the most volatile stock market crash we'd actually ever seen. But this kind of massive indexation and passive investing has led to where these kinds of massive moves can happen. And now both Michael Burry and Cathie Wood agree on the uncertainty of index funds. But they come to different conclusions as, they basically see the same thing, but they come to different conclusions. First I'll go into what Michael Burry's done. He's bought heavily into stocks that aren't traded commonly on indexes, such as GameStop, Bed Bath & Beyond, just undervalued value stocks that he sees as being good bargains in this current market. And he's also bought into Japanese companies. He's also somewhat of a trader, so it is hard to know what he's entirely thinking will happen as a result of this. He likes to buy and sell positions, usually jumping around in them every few weeks or months. But he did actually bet against index funds back in March of this year, similar to how he did before the housing crash with his bet against CDOs. So we really don't know if he still has plans to bet against index funds again, but my guess would be that since nothing has really changed since he initially released these statements, and if anything, he has been proven correct in February and March of 2020. So basically, if nothing has changed, and these indexes have returned to a risky position, he would probably place a bet against them again. That's just my guess. It definitely could be wrong, but he really doesn't give many clues as to what he's planning on doing next. As for Cathie Wood, she goes in a different direction of investing in disruptive innovation, which I've talked about before. And this is what her ETFs already focus on heavily. So she has companies like Tesla, Square, CRISPR Therapeutics, etc. These companies that are really on the forefront of technology and innovation. Now this would be a very risky bet in my position to make if you were a traditional value investor, as many of these companies aren't profitable right now, and should index funds collapse, as she and Burry are saying, these companies could go bankrupt or at least decrease dramatically in valuation. So I'm honestly kind of confused as to why she invests so heavily in growth and hype-based companies if she sees index funds collapsing, like she is saying. But we'll definitely have to see how all of this plays out. Anyway, let me know what you guys think down in the comments as to what you think about these individuals, Michael Burry and Cathie Wood, and yeah, ultimately what kind of direction you see these index funds and potentially the index fund bubble going.